pleasure for me to be the moderator for this session, and we've got distinguished members of the real estate industry. And for those people who are of wire, you can see we are gender balanced. We've got 2/3 majority. Okay, not exactly, because Onjeri was meant to be here, and I think she might have been delayed. So today's topic is about transitioning from renting to owning. How developers and financiers are aiming to meet this demand. So I'll start first with Mercy. Question I have is, how can rent-to-own portfolios be structured to create investable assets? And do you see potential for REITs, securitization, or credit enhancement mechanism to scale this model?
Thank you, VG. So at CPF Capital, we are directly involved in both residential as well as commercial lease-to-own or rent-to-own models. We currently run a TPS scheme for the residential properties under our portfolio. But for the purpose of this conversation, I'll speak to the commercial transaction. So we currently have a lease-to-own model with one of the county governments. And I believe this is a very good example of an investable asset, because what we've done is we've entered into a finance lease contract with one of the counties, and the cash flows are very predictable, contractually defined, and one of the most critical elements is that we've ring-fenced these cash flows, yeah? So we supported the enactment of a law to ensure that the pension fund monies are well covered, and the interest of the pension schemes are well covered as well. Yeah, so we had to have conversations with National Treasury, Controller of Budget, and currently in discussions with Central Bank to see how we can have an escrow to, of course, ensure that the pension scheme is confident. Yeah, but Vijay, to your question about how we scale this, so you've mentioned REITs, you've mentioned securitization. So one of our plan is to securitize these cash flows from this commercial building and raise funding through the capital markets. And when I mention capital markets, then the aspect of credit enhancement and credit guarantees come into play. We are very fortunate to have a local guarantee company in Kenya, Damana, which is a partnership between Pitch Group, that's a PIDG group, Africa Development Bank, as well as CPF as the anchor investor in Kenya. And the key role of Damana is to guarantee local currency debt. So having a rent-to-own model that is then guaranteed by Damana gives investors confidence, and also it strengthens the bankability of these instruments. So to your question, rent-to-own models can be investable assets, which then can be scaled using the various instruments in the market. We're talking about REITs, we're talking about securitization, as well as any other instruments like asset-backed securities. Then, of course, when you bring in the element of credit enhancements, then that gives investors confidence.
Thank you very much. We'll come back to that topic later on, but I'll cover it. You're a developer. What are the trends of uptake of financed buyers in your projects?
So we're in our 6th year now of selling between Tilisi and Maisha. And I think over the years, we've seen there's been a bit more of a demand for finance buyers. We're getting more finance buyers through the door. I think that's because rates have gone down generally, and the KMRC rates are fairly affordable at 9.5%. But still, I mean, over the 650 units that we've sold between Tilisi and Maisha, we've only had about 130, 140 mortgaged for financed buyers. So that's, I mean, just over 20%, which is quite surprising. It's quite a low figure. I think when we started this project, we didn't we didn't anticipate only 20% of our buyers would be finance buyers. It's increased in the last couple of years, but it's still quite low, I would say.
Yeah. That's interesting. Now that you're talking about only 20% of the buyers are actually financed by mortgages, we'll turn over to Beatrice, who might be able to give us a bit of insight. Beatrice, of course, head of mortgages at APSA. What are some of the mortgage misconceptions that, if well understood, will help transition more Kenyans from renting to ownership?
Okay, thank you and good morning. I think one of the things about the myths around mortgage is first that it's a death sentence. It's 25 years, it's 20 years, it's a long-term facility. So there's a sense that you're going to be with a bank forever. Yeah. So possibly some of the reasons. But I think one of the things that people don't understand is that you take a mortgage for 25 years for affordability. So you're able to qualify for higher loan amounts. You're able to qualify for a property that you want to go and live into. But you're able to accelerate your mortgage repayments. You can increase your monthly repayment. You can pay lump sums down into your mortgage repayment. And what that does is that you reduce first the interest you pay to the bank and also the tenure of the mortgage. So currently, with mortgages of 20 to 25 years, most buyers actually pay their mortgage between 7 and 9 years. So people actually don't pay for the 25 or 20 years. So that's the first misconception. The second one is in the early 80s, 90s, there was a lot of homeowners who were actually losing their property to the auctioneer. So that actually put fear in homeowners and home buyers. So they prefer short-term facilities that take so much longer to get into a home ownership or property ownership. And people actually shy away because they have the sense that the bank will actually come and auction my property. So the law has actually been amended to protect the home buyer, where the auctioneers cannot sell for less than a certain loan-to-value ratio of your property. So the advent of an auctioneer can come and sell your property for half the value. I think those days are long gone. So the fear should actually not be there anymore. The third one is in the event of the death of the borrower or the homeowner, there's a fear that then the bank again will come and take the property and my family will be left to pay a debt. Again, there's insurance that covers for death. So in the event of the death of the borrower or the homeowner, the insurance actually pays off the full mortgage, and people actually don't know that. So there's that fear of if the homeowner or the borrower dies, then the bank will still come and get their payment even after that. It also includes critical illness. So in the event, again, the borrower gets sick, the insurance company can actually pay off the debt if it's critical illness. And I think the last one is around the closing costs. Well, there's a time closing costs were very expensive. For you to take a mortgage, you need to pay the deposit, you need to pay the lawyer, you need to pay stamp duty. But now banks are actually financing the whole ecosystem. So you don't even need to look for money. If you don't have savings, or you have savings and you don't want to dip into those savings, you can actually get financing for the full property, including the deposit and the closing costs. So I think it's also about knowledge and historical myths and experiences that people have gone through that are making people fear the mortgage or the home loan. But I think a lot has since changed in the past. Yeah.
Okay, thank you very much, Beatrice. Shiv, you're a developer. There is a disparity in yield and financing rates. What does that mean for transitioning, and what can developers do about it?
Yeah, thanks, Gikonyo. So I think at Superior Homes, we've had a bit of a different experience with regards to mortgages historically. I would say 50% of our buyers are mortgage buyers. But we operate in a pretty different market to Kavit and the rest, because we're sort of in your 15 million shillings to 30 million shillings going up. So by that time, you're generally looking at household incomes and the rest. We saw a real slowdown in the mortgage market 2020 till 2023. You know, COVID, interest rate caps, it really created quite a flux and a very unhealthy situation in the market. Now, a challenge from the financing side, the developer side, has always been this issue over rental yields in Kenya. I think it's historically been an issue. Residential rental yields have 5.5, right? So if you've got a 5 million shilling home, you're probably paying 250K a year, 300K a year, 300,000 shillings, sorry, in every year in rent, so 25,000 a month, 30,000 a month. But the same, if you went to go and mortgage it, you would end up paying 55,000, right? You're now talking to someone who's probably earning 100, 150,000. They don't want to know about, you know, the extra 20,000 and owning this thing in 20 years. But what's happened recently is a seismic shift. And I think we, personally, me, bash government a lot with regards to a lot of things that they don't do. And we'll have time to discuss that. But one thing they have done very well is KMRC, right? It's, honestly, on the mortgage side, especially with the affordable housing side, it's a game changer. When your mortgage rate comes down 600 bips, right, from 15.5%, 16% to 9.5%, now SACCOs are coming in. We recently saw some SACCO financing at about 8.5%. I was talking to Kioi, IHS, they're seeing quite a bit of it as well. Rental yields are also going up. So that disparity that used to be 10% is now 1% to 2%, especially with regards to KMRC. And there's not much developers can do. It's really financial institutions who have to do the work. What we can do on the development side is ensure that we're applying for as many VAT incentives, for example, as possible. We're applying for as many corporate tax exemptions for 15%. We're applying to put in place innovative structures like REITs so that we can lower the cost of the unit as well. But on the yield side, I think there's been a lot of movement towards ensuring that home ownership can actually become a reality rather than what it was before, where really we were just building homes for investors to buy and then come and rent them.
Oh, thank you very much, Shiv. And at a later stage after this, I will allow the other panelists to respond to what others have said. But now, welcome to Caroline, Kiara. At least now we have achieved equality. Caroline, you are tipping the balance badly against us. But from just what are some of the PPP opportunities that can be adopted in accelerating the transitioning from renting to owning?
Thank you very much, Gitonga, and good morning, everyone. As Gitonga has mentioned, my name is Caroline Wanjeri. Apologies, I came in a bit late. And just to write on what Shiv has said, I think when you think about PPP, KMRC is a PPP, one of the very successful PPPs we've seen. As a bank, as a KCB, just out of KMRC, we are the second largest shareholder outside government of Kenya, with about 20% stake in KMRC. And having started the journey of home ownership for people in the region, because we're in about another 7 countries in this region. That's Kenya, Uganda, Tanzania, Rwanda, Burundi, South Sudan, and Ethiopia, where we have a correspondence office. For us, that the unaffordability, the lack of financial inclusion was a big thing that we struggled with right back from 1952 when we started, savings and loan that was leading our, mortgage providing company. So KMRC is one of those PPPs that are very successful, and I think when you think in terms of what can government and private sector do to ensure we drive more financial inclusion, is part of it is allow everybody do what they're good at. Let the private sector do what it is, what they're good at, create the environment, allow the environment, make the right laws, ensure the regulations passed are conducive to business, ensure ease to business is real for the private sector, and for government provide any de-risking tools can be there, because that's what I would call KMRC, to be. And I think, just as Shiv says, from the time we started KMRC, we've seen a shift. We've recently become also a shareholder of TMRC, that is Tanzania Mortgage Refinance Company. And part of it is out of the journey that we have seen and the impact that KMRC can do. But question is that enough? No, it's not yet enough. We still have a long journey as a country, as a region, to be able to get there. And what are some of the things that government can do? I always say, and having sat in different task forces in government needs to concentrate on regulations and let the private sector do, because if we all attempt to do it, we will fail. There's a reason somebody has walked the journey of being a developer. Shiv will tell you the journey they've walked with Superior Homes, and it's not easy. So for somebody to just wake up and think you can start doing it, I think the thing is, what can we be able to do? There's a huge opportunity in terms of mobilizing resources for real estate in the market. If we look at D-rates today, there's still a bit of issues to be sorted on the tax elements of it, and I'm sure there'll be a panel that will be speaking to that. If you look at some of the regulations that we passed to ease affordability, including waiver of stamp duty, today there is no guideline that has been developed to make that clear. So a customer comes and says, okay, there's a law that says as a first-time home buyer, I have waiver for stamp duty. But when you come in, where are the guidelines to support that? So it's about, we must, whatever we promise, then we must ask ourselves, have we delivered? Because that's one of the key elements that, would even unlock even better. Because today, if all first-time home buyers can actually have, because stamp duty alone is about 4%, that would unlock another whole potential coming through. If we look at our pension funds today, we are sitting on 2.1 trillion actually, 2.1 trillion. What can we be able to do? What are the opportunities that exist in there for us to get more into the secondary market, whether it's asset-backed, securitizing the book that we have to be able to unlock the potential. Because when private equity investors come, they want to come in 2 years, 3 years, put their money, get their return and get out. So what can government, between government and private sector, what instruments can we create in there so that we can attract investors who want to come in to be able to put in their money 2 years, 3 years, but currently a lot of developers shy off. And I'm sure the few that are in the room will tell you it is painful. I can see Tilisi. He'll tell you it's painful when you have capital tied in and you can't get it out. And all the people that have invested are asking, what can I do? So I do hope that we can have a lot of shift in working, in asking ourselves, how do we ease business for the country, for the region? How do we make it easier, including those tax holidays? And let's not just indicate there for political mileage, but let's put it there and mean it. So if there's a guideline that needs to be developed to actualize a regulation, let's sit down and get that guideline very clear so that between the different government arms, whether it's Kenya Revenue Authority and the ministry that's running with that, let's clear it. If there is an incentive that has been given to a developer, let's not make the developer have to walk into an office. Let it be black and white. For me, if you have said you're giving me VAT on import duty, I just need to click a button. And I think we've done a great mileage as a country, even with e-citizen, with all government transactions being automated. And I think it's high time as players in the real estate market, we come in and insist that some of these things are also automated because it will bring transparency, it will bring accountability, and definitely it will eliminate corruption that, hinders development. So it's a very exciting space that we are in. And I think very soon, Kenya is sort of like taking a leadership on unlocking accessibility for the region. Last year, we went for the Affordable Housing Conference. I think it was in Singapore? It was in Singapore. Yeah, it was in Singapore. And even listening to, apart from Asia, where they've done a lot, countries like Brazil, there's an opportunity for Kenya to be able to, shine out there. But there's still a lot more that needs to be done to really lock affordability. When you talk about social housing, if you look at, and all these things are tied You can't ignore urban planning, you can't ignore all this because they have to be tied together. So if you think about social housing, the state of slums in our country today, a lot has to be done, and there needs to be participation of both public and private. For us to be able, that person that is paying, because in fact they say there's a poverty penalty, because you find the person living in the slum pays almost 100 times more what me and you pay for electricity. For a basic need like water, they pay 100 times more. So it doesn't mean they don't have money. They have money. But by being poor, the system punishes them even more. So what more space, what opportunity is there for private sector, and what role can government play? Yeah, because private sector can come in with innovation to put up multiple units, and government comes in to sort of like de-risk, yeah? And in a way that, we have also inclusion as human beings, so that then we don't have people who are living very wealthy, and then you have another state where people, what kind of a world can we be? So I see a big opportunity in that space, longer mortgages, maybe even generational mortgages, but most important, tenant purchase scheme, rent to own for that segment of a business. But again, create an environment where as a private equity investor, I can come in, put in, and then you take over. And it's possible. I think it's very possible between public and private to do that.
Thank you very much, Wanjeri. I will divert from the usual way of doing the panel. This time I'll allow for two or three questions from the audience, and then I'll come back to the panelists with some other questions. Is there anyone who's got some burning question around this topic, transitioning from renting to owning? Anyone would like to ask a question? Maybe two or three questions? Wow, this is a very nice class. No one asks questions. I spoke too soon. Yes. Andre, and then who else is there? Boniface? Okay.
Good morning, Andre Lubim of Has Consult. We know that one of the ways of reducing acquisition costs for potential buyers is buying off-plan. So how can we make mortgages available for off-plan buyers?
Okay. Boniface?
Hi, my name is Boniface. Two questions. One, if I have a mortgage, can I get another mortgage with KMRC? And two, can I use KMRC to buy something that is not a residential house, like a shop or a go down?
My name is Zaria. I'm going to ask on behalf of Gen Zs. Renting to owning is, it's amazing it's a good theory. But for Gen Zs, how practical is that? For us to try and get a job, number one, maybe our credit score is really bad, but we are still trying to own something. And paying rent all the time does not make sense. So we want to rent to own. But we are poor. So how would you help someone like me who wants to invest and wants to grow, but maybe I don't have the means to do that?
Okay.
Can I ask on behalf of millennials? I'm just joking.
That's a Gen Z, not a millennial.
Yeah, good morning. I had a question also regarding mortgages, especially the stamp duty, which I think you've touched on can also be a hindrance. Are there plans to introduce different bands for stamp duty to make it possible, obviously for first-time buyers to be exempted from stamp duty? Do you think that's something the industry can rally up and propose to government so that they can have those exemptions, and then also have stamp duty bans as well, depending on the houses that are being bought? I think that potentially could help.
Okay, who would like to answer? Yeah, Beatrice?
I'll take some on the KMRC. So for KMRC, the purpose was for home ownership, to increase the number of people who actually own homes. We've been on the 27,000 mortgages in a country for I think the longest. I've been in this industry for 20 years. And we keep saying we're almost at 30. We're at 26, we're almost at 30. We're 27, we're almost at... So the 30,000 conversation has been there for the longest. It's only last year that we actually hit the 30,000 mortgages mark. And we literally grew by 8% because KMRC has literally changed this conversation. So affordable housing, because of the small ticket deals, the middle income, a lot of people are being able to afford. Shiv Arora mentioned about the uptake. He's not struggled with mortgage customers because, again, for the longest time, mortgage was for the affluent. It was a high-end product. It was for the people living in leafy suburbs. So our portfolios were really in the leafy suburbs. But now, because of affordable housing, anybody who can actually pay rent can own a property. So KMRC is for home ownership. It's not for commercial. It's for residential. One KMRC facility per person. Yeah? Okay. So you have the opportunity. If you've not taken a KMRC facility, as long as it's for own occupation, then you can actually qualify. No commercial properties. Yeah. Then I'll ask Caroline.
Jerry, you would like to add something there?
Yeah, so I want to add something for the Gen Z. You're not poor. So, so a lot of innovative financial solutions are needed. And, there are a lot of risk-sharing frameworks that can be developed, and I'm aware KMRC is actually in the process. We're in the process of just getting an RSF model that we can be able to accommodate those that are viewed as poor, because nobody is poor, because at the end of the day, today you're going to go to a house, isn't it? And even that person who's living in a what I'll call a shack in a slum is actually paying rent. But the way rent in the slums is about between 3,500 and even to a high of 5,000. But now when you accumulate all the other things that they have to pay for water 100 times more than you do, then they have to pay for electricity 50 times more than you do. On top of that, they have to deal with a flying toilet, or they actually have to choose, do I need to? Because they pay to go to the toilet. So when you add up all that, they actually can afford. And maybe they're actually not poor. If we took time to organize our cities, if we took time to just concentrate on ensuring that, financial inclusion comes alive. So, and I don't want to preempt, but I know this country is ripe for tenant purchase schemes. It is very ripe for tenant purchase schemes. We have some work we've been doing with MIVIDA, supported by FSD. We do hope that we can be able to launch something. It's still under baking to just allow, because having worked with the likes of ACON to provide student housing, we do there are a lot of parents who come and say, if I can afford to pay for my son this amount as a student, can I have a way that even as I pay this rent, I can have a journey that they can own it later? So it's possible. You can have a journey that you start as a tenant purchase scheme, where you're just a tenant, and in there take that time, because a lot of the challenges why many people cannot access mortgages is they don't even have a credit history. So during that time, work to build a credit record that can help build a scorecard that can actually allocate a limit based on the behavior during that transition period when you are a tenant, and looking at your behavior, what we call behavioral scoring, how you were paying. So it is possible, and then now later convert you into a mortgage. Because as you rightly put, there are segments that will not be able to afford the mortgage. So we'll need to think of longer tenors. And I think many of you have cited the Affordable Housing Act 2024. It has actually already introduced 30 years mortgage. So that's the beginning of generational mortgages starting in. And I think guidelines will be released soon. It should come alive. And in there has actually already provided for tenant purchase schemes. So it is near, it is coming to cook. On the waiver of stamp duty, very good suggestion, and I happen to also sit in the board of Kenya Property Developers Association, KPDA. And one of the things we push as you know, as a sector that is pushing and lobbying to have some of these changes done is to even help put some of these guidelines in place. So I can tell you as we speak, we've been, even as of yesterday, we were actually with a meeting with the ministry just pushing to have those guidelines out, even offering ourselves to sit to do the guidelines. Because remember, nobody wants to lose income. KRA knows they will lose income, so they'll not be in a hurry to do it. We are basically telling government you'll not get some income. But very good ideas, and I think through those forums like, you know, KPD, and I know there are a lot of bodies here that represent the real estate, it's an opportunity to be able to give those fantastic ideas and see whether we can make the onboarding journey much easier. So I don't know whether I've picked all the issues.
Yeah, I think so.
Yeah.
Okay, now we'll just go to the next set of questions because we don't have much time. I'll ask one question and you talk briefly. Please, let's keep it to 2 or 3 minutes, and then you put your part in short also so that I don't have to come back to you. So I'll start again with Mercy. What risk-return profile makes rent-to-own attractive or unattractive for institutional investors, and how can we de-risk these structures to mobilize long-term capital?
Okay, thank you. Thank you, VG. So I think from a pension fund's perspective, rent-to-own models are compelling when you have stable cash flows, yeah? But to be able to attract institutional investors like pension funds, there are 3 key considerations, yeah? The National Treasury has constituted a committee of experts, which I humbly serve in, and the mandate of this committee of experts is to give recommendations to the government on how we can mobilize private sector funding from pension funds, insurance companies, and long-term investors into PPP projects and government projects like the JKIA project, the Nairobi Mau Summit project, the Ketraco projects. So there are 3 key considerations that pension funds look at and any other investor looks at. So one is the return on the investment, yeah? Shiv mentioned that we are looking at 5% for property. Any investor will be looking to beat the inflation on an annualized return, yeah? So one, return on the investment. The other one is return of the investment, yeah? There's no way any investor will put in money knowing that the capital is not coming back. So for property investments, there has to be a clear offtake guarantee to be able to cover some of these risks, yeah? Then the third one is clear sight of an exit plan. There's no way pension funds or any fund managers would put in money in an investment that doesn't have a clear exit strategy. So like for example, for property, that's what we're talking about, instruments like REITs. For a REIT, at least an investor knows they can be able to exit, yeah? So I think for attracting long-term capital, these are some of the key considerations that we have to look at. Of course, there are other, apart from the returns, there are other critical risk aspects, like I mentioned earlier on, issues of credit guarantees, which can cover the risk of defaults. And of course, in terms of operational inefficiencies, we can have automated rental collections that then gives you oversight of the collections. So 3 key considerations: return of the money, as well as a clear exit strategy.
Thank you very much, Mercy. Good caveat. What have you been doing to try and achieve higher sales?
Okay, so I think firstly, this whole session is about demand. I personally feel it's really tough out there. It's a tough environment, it's a tough economy, and we are really trying to push sales. We're in our 6th year of sales, and by now we thought we would have got the traction to really just self-market ourselves and just bring in the buyers. But we are finding that we have to really be aggressive in our marketing and always be thinking about how to improve our sales. Basically, we just need the money, and we need the money to start the new phases. So we're trying things like, I think somebody mentioned here that we're looking at, well, we have accepted 105% financing for some of the apartments that we're doing. So we are also, once we get a bank guarantee, we are actually allowing people to take over the house. it's yours, or you can even start renting it out. It just improves their paybacks and their returns on their investment. Although we won't get the money in a few months' time, we allow people to take possession. And we give very generous cash discounts. I know that's going against what we're saying about mortgages, but in reality, we need the cash. So we give good cash discounts, we get the cash in, we can start our new phase. I think my parting shot would be that developers like us, we get asked, oh, do you have your own rent-to-own scheme? And the reality is, no, we can't even look that way. We can't afford to have our money held up for like 10, 15 years or whatever it is. We actually need our cash flow in, and we need to roll out all the other land that we have to develop.
Okay, thank you very much, Kavit. Shiv, what are the initiatives in place that currently exist to allow a transition from renting to owning? And what are you doing enough?
Yeah, I think in terms of the initiatives, Kikonyo, we've discussed quite a bit. There's a lot. There's KMRC, there's tenant purchase schemes, there's the rest. But are we doing enough? Possibly not. Kavit raises a very valid point. Every developer here would love a mortgage, right? But we love cash in the bank more than we love mortgages. We don't really care where the money comes from. Let's call a spade a spade. The quicker the money comes into your account, the happier you are. Now, can you encourage people towards home ownership through mortgages? For sure. But I think it's touching on something Wanjeri said. There's been a lot of like almost government competing with the private sector, right? And government's not in the business of doing business. So when it comes to can we do more, what would be helpful, and we keep saying it at every panel, but last time we spoke about the demand side, so they sorted KMRC, so hopefully there's someone listening to us, and next year when we come it will be a bit better. Firstly, I think the delivery of affordable housing units from the government just needs to move back to the private sector. There's reasons we didn't do it. We don't find the price right, we have issues with titling, we have issues with infrastructure, so can we do more? I struggle to think what else sort of private sector can do that they're not already doing, right? They're very innovative, we work with banks, we provide MOUs, we help clients along, we give them easier entry paths, we help them rent out their unit. But what can we do is back to infrastructure. It's really, number one, let private sector focus on delivering the units, and let government create a conducive environment. There was recently, when the president spoke about stamp duty exemptions, it was during a public rally. And, 2 buyers wrote to me and said, oh, you can't charge me stamp duty, or we're going to sue you. I was like, great, go get me the exemption from the Commissioner of Income Tax, and you don't have to pay, it's not coming to me. So infrastructure is a big issue. KPLC, water, titling, and transport. You can have housing, even where we are, in Athi River, Lukenya, Ruiru, you can put up affordable housing, and you can enable people to move from rental to ownership. But whatever they're saving, they're going to be spending on transport. So I think there's a lot that needs to be done from the government side to improve infrastructure. If you do that, private sector will take care of the rest. So I guess my parting shot is, again, let's separate roles and responsibilities. Let private sector do what they're good at, and let government do what they're good at. And then ultimately we'll make some inroads towards dealing with this housing crisis. There was issues around capital markets, but I think they're being discussed, a lot more discussions around REITs, TPSs, deepening of the capital markets. All of that is helpful because it's alternative pools of capital that just support the same initiative.
Okay, thank you very much. I can see I've got less than 1 minute. I hope that Mark Danford's, I've got 5 minutes. Mark Danford, thank you very much for donating some of that. Beatrice, for someone who is unsure on how to transition from renting to owning, or not sure whether they are ready for home ownership, what would be your financial service?
So today, if you're paying rent, you can own a home. literally. Like you can convert whatever you're paying into rental into a mortgage. Because if you calculate, if you've been paying rent for the past 15 years and you calculate how much you've actually spent, that's money gone, no investment, it's an expense. But if you convert that rent and put it into a home ownership property or mortgage, then once you're done with paying the mortgage, you actually own an asset. Yeah? There's also appreciation of the property over the period of the mortgage. It will actually appreciate. So you get two things. You actually have an investment, you have home, you have security, and you know for sure that there is no landlord that will be following you up for rental for rental payments. Today with the KMRC mortgage, the interest rates are fixed. So we've seen in the recent, the interest rates really just keep going up, up and up. So if you were servicing a mortgage, I know you've gotten interest rate increases and letters quite consistently. But with KMRC, the interest rates are fixed. So you're literally moving from paying rent into a fixed mortgage plan, and that will not change for the life of the mortgage. So my parting shot is just to encourage people that I think the time for home ownership is now, and we're going to move to a 60,000 mortgage mark much, much faster than we ever did to move today to 30,000. So I see this landscape changing, and I think it's very, very exciting for home ownership. Thank you.
Thank you very much, Beatrice. Caroline, now, how can developers, including government, drive sustainability as they explore models that will support transitioning from renting to ownership? You have 3 minutes.
Okay, thank you. I've been warned I have 3 minutes.
Yes.
Yeah, so driving sustainability. So whether you want to give it an SDG lens, looking at the Sustainable Development Goals, and thinking about financial inclusion. I'm very big on financial inclusion. I'm very big on gender diversity. What can we do, even as financial institutions, to even support developers to drive more sustainability so that even the projects we are developing can stand the test of time? If I look at Mumbai, I guess another 25 years ago, Mumbai was probably where Nairobi is. And I think at one point they had to sit and just ask themselves, you know, we have to do this better. And I think it's time, and I speak this because of, you know, urban planning. It plays a very critical role in how we are developing our cities. The likes of Tilisi, the likes of Tatu City, that have taken time to have a master development, the likes of Centamri, those are likely to see the test of time. The question today as a developer I'll ask is, as you do your development in another 25 years, is it going to be a demolition? And unfortunately, we have a few that are still doing projects that in another 25 years, given the very rapid urban population growth and very high rate of rural to urban migration, there's a very high probability that in another 25 years, there's some developments that have been done in this country or currently are in construction but will have to be brought down. So the question I'll ask as a developer is, do you put that lens of, will this survive another 50 years? What are the markets? What are the things that are changing? What are the things I need to look at? We owe Mother Earth a big deal. So we need to ask ourselves, how safe is it? What is the impact on the environment? As I said, you know, if you put an SDG lens, is at the end of the day, what I'm doing, how am I supporting the communities that are affected? Am I making it even worse for them at the price of profit? Or am I making sure that even as I do a development, the communities that were probably there or that surround the development that I've done have not been affected or are better? Because it is that being human, you know, when you talk about sustainability, you know, KCB has been in existence for 128 years. And whenever I have to finance a project, I always ask, 128 years after I leave this earth, will I have guided the bank to put money in the right place? Or will I have guided the bank to put money in a project that comes down? So whether it's about renewable energy, the resources are not replicating themselves. The water we have, that is it. I got a shock the other day when I drove to Mount Kenya on a project that we were doing with the Tana River. And I was so shocked to find that the water river sources are actually drying up. So we're actually killing ourselves. Yes, we'll have money, but we are killing the earth. So how are we looking to protect our water sources? When you get that water, even when you're designing that building, how are you ensuring that that water is recycled? How are we managing our waste, our solid waste? Are we making the environment worse? But most importantly, and as I conclude and I make my final shots, I think the market is ripe right now. Rates have been going down. I think now currently CBR is at 10%. The economists, the forecast done by the economists, and I can see Julius here, they tell us there's a likelihood that it's actually going to go down. So there's a likelihood in this country we'll have a single-digit CBR. There's a lot of pressure for financial institutions to bring the rates down. So on that bit, the government is doing a good job, but I'm a banker, I shouldn't be saying dear. Russo should not be hearing this, but we've got to, it's part of inclusion. We've got to make credit accessible for all this to happen. So I'm saying it's ripe for us to raise the other instruments. I know initially it was very hard to raise a bond in this market, but it's time that as stakeholders, we start thinking of raising green bonds, sustainability bonds, gender bonds. This is the time. The time is ripe. I think there's an opportunity in there because the returns can now be very good as banks bring the cost of lending down.